With due respect to the departmental initiative on the creation and development of e-content, in this particular session, we will discuss and solve the problems on return on average investment method, average return on average investment method. For the program BCom, subject financial management, 5th semester, Vijayanagara Sri Krishna Devaraya University, Ballari. As we have discussed in the earlier session, the theoretical aspect on the return on average investment method. In this method, the return on average investment is calculated using of the average investment for the purpose of return on investment is preferred because of the original investment is recovered over the life of the asset on account of depreciation charges. Average investment is considered, and that average investment is nothing but the opening initial investment or the total investment divided by 2 or the total investment divided by the total number of years. The formula to find out the average return on average investment method. Return on average investment is equal to total profit after depreciation and tax divided by average investment. In previous session we have studied, we used to take the net investment. Here total profit after depreciation and tax, that is to be divided by average investment. Another one is average return on average investment method. The name itself indicates average return on average investment. This is the most appropriate method of rate of return on investment. Under this method, average profit after depreciation and tax is divided by the average amount of investment. Formula is average annual profit after depreciation and tax divided by average investment divided by 2. There are the slight changes in the formula. You have to keep in your mind, or the students are advised to add the formula or be particular about the formula. Once you are particular about the formula, you can place the values easily. Problem: calculate the return on average investment from the following information. Return on average investment. A machine costing 6 lakhs, scrap value is nil, depreciation is charged on straight line method. Profits for the 5 years were as follows: 50,000, 70,000, 80,000, 60,000, 40,000 respectively. We can start net investment. Total investment minus scrap value. Here the scrap value is not given. 6 lakh is the investment, so that is the net investment. Average profit, in the previous session we have studied the formula. Average profit is equal to total profits minus total losses divided by total number of years. Here there is no loss, so 50,000 plus 70, that is 1,20,000, plus 80,000, 2 lakh, plus 60,000, 2,60,000, plus 40,000, that is 3 lakh. 3 lakh divided by 5 years, that is 60,000. So the average net investment is equal to, net investment is 6 lakh, but we need average net investment. Here the information is not given, so the total investment divided by 2, that becomes the average net investment, that is 3 lakh. Now the return on average investment. Total profit after tax and depreciation divided by average investment. Total profit is 3 lakh divided by average investment is 3 lakh into 100, it comes to 100%. Book example 2. Calculate the return on average investment from the following information. Machine costing 12 lakh, scrap value is nil, depreciation is on straight line method. The profits for the 5 years as follows. That is 1 lakh is the profit, 1,40,000, 1,60,000, 1,20,000 and 80,000. Only the figures are changed, rest all the remains same. Students, you can solve the problem In the previous problem and this problem, there are no more adjustments. Net investment is equal to total investment minus scrap value, no scrap value, so the total investment itself is the net investment. Average profit you need to calculate. 1 lakh is the profit. 1 lakh, 1 lakh 20,000, 1 lakh 40,000, it becomes 2 lakh 40 plus 160, 3, 4 lakh, 5 lakh 20,000 and 80,000. Total 6 lakh. 6 lakh is the profit divided by 5 years. That 6 lakh divided by 5, it comes to 1 lakh 20,000. So the average investment, total investment is given. Our net investment is 12 lakh. Average investment, no information is given, so should be divided by 2, it comes to 6 lakh. So return on average investment is equal to total profit after tax and depreciation divided by average investment. Total profit is 6 lakh divided by 3 lakh is the total profit is 6 lakh divided by average investment 6 lakh into 100, that's 100%. So book example 3, calculate the return on average return on return on the average investment from the following information. Machine costing 6 lakhs, scrap value is nil, depreciation charge on straight line method. The same problem, we need to calculate the average return on average investment. So the net investment is 6 lakh. Average profit we have to calculate with the formula. So total profits is 3 lakh for 5 years. So 60,000 is the average profit. So the average net investment 6 lakh is the total investment divided by 2, it becomes average net investment 3 lakh. So the average return on average investment, the formula will change. Earlier we used to take total profit. Here you have to take the average annual profit divided by average net investment. So 60,000 is the average annual profit divided by average net investment is 3 lakh into 100, it comes to 20%. Another example, calculate average return on average investment. Machine costing 12 lakh, scrap value is nil, depreciation is on straight line method, profits for the 5 years given 1 lakh, 1 lakh 40,000. Same for the second book example. Only thing is that here you have to calculate the average return on average investment. Net investment remains the same, 12 lakh, because the scrap value is nil. Average profit, you have to add all the profits divided by 5 years. After adding all the profit, it comes to 6 lakh divided by 5, that comes to 1 lakh 20,000. So the average investment, total investment divided by 2, that is net investment 12 lakh divided by 2, it comes to 6 lakh. So the average return on average investment, so 1 lakh 20,000 is the average annual profit divided by 6 lakh average investment into 100, it comes to 20%. Books for the reference, Shashi K. Gupta, R. K. Sharma, Management Accounting Principles and Practice, and Dr. G. V. Baligar's book on financial management. Thank you, one and all.